Hi and welcome to Sifter Fund's quarterly results review. In this presentation, I will walk through the fund's performance in the first quarter and introduce a few of our companies and their outlook. At first, however, a few words on a topical issue named equity diversification, an example of which we got an unfortunate reminder with the start of the war in Ukraine in March. It is sometimes said that it's in a global world, everyone is in the same boat, and geography doesn't protect the investor. There's without question a stern claim to this, but history has also shown it to be partly false. Sadly, we had to experience it again, and the need for a more diversified portfolio has become even more important than before. The basic idea of Sifter Fund's equity diversification is a bottom-up approach, which doesn't take an active stand between countries or industries. Stock selection for the portfolio is always made based on the company's business operations. First, we analyze the company in detail, and finally, the industry and geographical situation. At the same time, however, we have ruled out several countries where the political country risk is too high, and that's why, for example, we have eliminated Russia and China from the Sifter's stock screening already years ago. Let's look how Sifter Fund's companies are geographically diversified. Currently, the companies in the fund are spread across 9 countries. Geographical allocation and emphasis have changed over the decades as new companies have been invested in and old ones sold. These decisions are not based on the macro view, but are based on the company's competitive advantages and predictable earnings, so to say, the company's price-to-quality ratio. In Sifter portfolio, the United States accounts for about 50% of the portfolio, and when two of our companies from Canada are added, North America accounts for nearly 60%. In Europe, we have invested in 5 companies with a combined weight of just over 20%. And in Asia and Japan, respectively, we have just under 20%. In conclusion, we think the fund is well diversified and provides protection for the investors in geographical crises. Let's look at the fund's sector allocation, the other important factor in diversification. In the Sifter portfolio, the companies are currently divided into 20 subsectors. The largest field of activity is the players in the pharmaceutical industry, with a weight of about 12%. The second largest place is held by semiconductor companies or semi-equipment manufacturers operating in that value chain, with a total combined weight of just under 20%. The goal of our investment strategy is to find the best company in its sector or niche market, and therefore we avoid excessive concentration on companies in one sector or direct competitors. Let's return to the results of the first quarter. The year began with a sharp decline in share prices, and in January the value of the fund fell by 9.3%. The reason for the decline was the correction in the share prices of growth companies after a strong year in 2021. For example, Microsoft share fell by about 15%. However, we didn't reduce the weight of these stocks because we believe that these quality companies will perform quite well in the future. In February, the stock market leveled off, and finally in March the fund's value already rose by 3.9%. For example, the war in Ukraine in March had little effect on global stock prices, unlike on many European stock exchanges. In the end, the first quarter of the year ended with 6.4% decline for the fund, which is quite a good result after very special events. Next, let's see what actions we took for the portfolio in the first quarter. At the end of February, our team conducted an in-depth analysis of the current portfolio and evaluated the impact of the Ukrainian war on our companies. We concluded that our investments' business operations are not in danger. Only a few of our industrial companies with operations in Europe are exposed to the consequences of the crisis. However, we believe that these are moderate effects, and we didn't see the need to change the portfolio's weightings. Since the war broke out, our estimates have remained the same. During the past quarter, the Sifter Fund made one new investment. We studied Universal Music Group for more than 2 months and finally conducted that the company meets Sifter's quality criteria. The Dutch UMG is the world's largest record company. We like the company's earnings model, where more than half of its revenue comes from the people listening to music produced by UMG through different streaming services like Spotify. We expect the long-term outlook for UMG to be promising. The company earns royalties from the music it produces far into the future, even for several decades. Most of the royalties come from the songs released years ago, which improves UMG's earnings predictability. We believe that the music streaming will become more common, especially in the older age groups, and UMG will get a significant slice from this growing end demand. The UMG investment was financed by selling off S&P Corporation position and slightly reusing the weights of Costco, Old Dominion, Atlas Copco and ADP, the current investments. The reason for the lightening of the weights of these current companies was the rapid rise in the share prices of these companies in relation to the company's earnings outlook. So to say, the expected earnings yield decreased because of the increased share price. In this way, we aim to improve the price-quality ratio of the Sifter portfolio and enable good returns in the future as well. Let's look at the fund's biggest gainers and decliners over the past quarter. The biggest gainers were the Northwest Company, Canadian National Railway and Deutsche Börse. Correspondingly, the portfolio decliners were Autoliv, Lam Research and Koito Manufacturing. In short, a few words about our biggest gainers. The Canadian retail chain The Northwest Company is a store of its own. The more than 200 years old company has sales of just over $2 billion in the sparsely populated areas of Alaska and Canada and the Caribbean islands. One of the company's competitive advantages is operating in difficult areas where logistic chains must be unique. Among other things, the company has its aircraft and seaplanes to transport merchandise. In addition, barriers to entry are well protected geographically. The company makes a growing profit from year to year and pays a dividend of more than 4%. The Northwest Company's share price has typically gone upstream when shares of IT and growth companies have been in downswing. This investment has been in Sifter's portfolio for 5 years now, and we will continue to hold on to this company, which is quite secure. Another clear portfolio gainer is the Canadian National Railway. With more than 30,000 kilometers of railroads, it's one of the North America's largest railroad carriers. We think that one of the company's competitive advantage is the effective network. Canadian National can transport over 70% of its total freight by using its own network. By utilizing its railroad networks, it's cheaper for customers and more profitable for the train company. Recently, the demand of freight transport has remained high. In addition to that, company's balance sheet and cash level are in even better condition, and the company announced that it would raise a dividend for this year. Although high inflation has affected food prices, Canadian National has historically been able to pass on increased cost to its customer. We invested in the company in 2018 and will continue to be its owner. Third and finally, the biggest gainer was the Deutsche Börse. Although Sifter doesn't invest in banks or financial institutions, we have found promising quality companies in the service providers in the financial industry. The reason we don't invest in banks is that it's very difficult and uncertain to know the balance sheets of banks. Another and more important reason is that most of the banks are not much different. Competitive advantages are therefore limited. In contrast, Deutsche Börse is a star in its field, and its operating results have increased due to the volatility in stock market. In addition, rising interest rates are expected to improve the company's earnings. One of the Sifter's decliners in the first quarter was Autoliv, which manufactures passive safety devices for cars. The Autoliv business first got hit from the COVID pandemic when car production was almost halted. After the share price decline caused by COVID in 2020, the Autoliv share price has rebounded more than double. However, the latest downturn was mainly due to the war in Ukraine in March. One could say that Autoliv has suffered the most from Sifter portfolio companies in Ukrainian crisis. However, we remain a conviction on Autoliv. We estimate that company's stock will offer an excellent 5-year earnings performance for us, but the risk relates to how quickly new car production returns to normal levels. Another decliner was a Japanese Koito Manufacturing, also from the car manufacturing sector. Koito is the world's largest manufacturer of the car lights. The company is a pioneer in LED lightings and has a dominant market share, especially in Toyota headlights. The company's share price has already risen more than 100% since the bottom of the COVID pandemic, but due to the chip shortages, among other things, the pace of a new car production has also slowed down Koito's earnings. We started reducing the company's shares in Sifter portfolio last autumn, and currently Koito's shares is only about 1% in the entire portfolio. And we are about to sell the rest of the shares in the near future. And finally, the $1 million question: what does the future look like for an equity investor? It's a question we would all like to know the answer to. Unfortunately, uncertainty is the price an equity investor must pay to earn returns in the long term. One way to alleviate this uncertainty is to choose only very high quality companies for your portfolio and get to know them as well as possible. When the stock market collapses again at some point, the knowledge that the businesses you own are in good shape, balance sheets are solid and earnings sufficient will give a long-term investor some relief. For the Sifter portfolio, we have tried to select what we believe are the highest quality companies around the world. Although the current outlook for the companies in the portfolio is quite positive, we are constantly monitoring them and switching to better companies whenever we see an opportunity to improve the portfolio resilience. Thank you for being here, and if you wish, please contact us and let's talk more.